Sorry, I'm just starting the recording now, so I'll just repeat a few things I've said. So, like I said, we are looking at the trend indicators today. And from the word trend, trend simply talks about direction. What these indicators help you to do is they help you to identify the direction the market is going. That is simply what they help you to do. The oscillators help you to confirm a trend, while the trend indicators help you to identify the trend, that is the direction where the market is going. And we'll look at a few of these indicators, right now in this webinar. So I'll go over to the technical indicator menu, which is this area that I circled. I'll click on the button and we have this drop down menu and you can see trend. Then we'll scroll to the first one, which I will show you, and that will be normally I like to start this with a moving average. It's a lot easier for us to understand. So moving average, I'll click on it and this menu here will appear, and I'll change the only thing here to 200. That's period. Moving average actually comes with different periods. And under the MA method, there are about 4 options there. I prefer the exponential uh, moving average, and I'll leave the other one to the color to royal blue, and I'll click OK. Now, this is a moving average. What does this indicator do? The moving average indicator helps us to identify the direction the market is expected to go to. Now, the simple rule around the moving average is this. Now, these red lines and green lines are called candlesticks, and they are used to represent price movement in the market. So when you have a continuous bearish movement, you will have the red candlesticks all going downwards. That indicates the market is in a downtrend. And when we have the green candlesticks all moving upwards, they indicate that the market is going upwards. But the question is, at what time do we expect to have a sustained bearish movement of the candles or the sustained bullish movement of the candles? We can use the moving average to identify that. Now, it's currently on the daily time frame. I'll go back to the 4 hour. That's maybe closer to what we normally trade as individuals. Now, as you can see now, for the moving average, anytime I said it that the candles represent price. So anytime the candles, open above the moving average, that is, when they cross from below to above the moving average, it indicates the market is going to be buying. It indicates an upward movement, or what we call a bullish movement. And on the other hand, if you scroll backwards, we'll see at the point where price also broke out below the moving average, and that indicates when we have a bearish movement of price. Again, if you scroll backwards, we can still see a time when price breaks out below the moving average and it gave us a bearish movement. Again, price broke out above it here and it gave a bullish movement. So the simple rule is this: anytime price breaks out above the moving average, it indicates we have an opportunity to look for a bullish trade. And whenever price breaks out below the moving average, it indicates that we have an opportunity to look for a bearish trade. That's just a simple rule around the moving average. Now, I'll show you now another indicator. We'll still match everything together so that we can even form a simple strategy out of all these indicators. So I want you to stay tuned to this class because you're going to learn a strategy in the course of this class. Now, the next indicator I want to show us is the ADX. Oh, sorry, before I go to the ADX, let's go to the parabolic SAR. Parabolic SAR or parabolic SAR. As you can see it here, I'll click on it and this menu will appear. Now, you're not going to alter anything on this indicator. Just leave it as it is and click OK. And this is the parabolic SAR. The SAR stands for stop and reverse. Stop and reverse. That's SAR. So how does this indicator work? This is how it works. Anytime the dot crosses from above to below, it indicates price is ready to go in a bullish direction. Again, when the dot crosses from above to below, it indicates price is ready to go in a bullish direction. Also, whenever the dot crosses from below this is bullish. Then if it crosses from above, well, sorry, whenever the dot is above, it indicates we are looking for an opportunity, to look for a bearish trade. When the dot crosses from up here to above, then we're looking for an opportunity to sell. Or in a simpler way, whenever the dot is below the candle, we're looking for an opportunity to buy. And when the dot is above the candle, we're looking for an opportunity to sell. Again, when the dot is below the candle, we're looking for an opportunity to buy. And when the dot is above the candle, we're looking for an opportunity to sell. And we can do that on and on and on like that. Now, the third indicator I'll match for us this afternoon is the ADX, the average directional movement index. And it's equally a trend indicator, average directional movement index. Now, this indicator, from what I've said so far now, for the moving average, when price crosses above the moving average, it indicates we're buying. When it crosses below, it indicates we're selling. For the parabolic SAR, when the dot is below the price, it indicates we're buying. When the dot is above the price, it indicates we're selling. Now, for the ADX is not really going to give us a direction immediately like that. It's different in the way it works. Now, for the ADX, what the ADX does is that it's going to tell us when the market is volatile enough for us to take a trade. That is what it does. It helps us to filter noise. It helps to filter us from taking trades when the market is ranging. When the market is ranging, is a time when price is in a state of equilibrium where it is neither buying nor selling. So what the ADX does is that it helps to prevent taking a trade in such a period. So it only helps us to take trade when the market is trending, either in the upside or in the downside direction. Now, the ADX itself does not give you the actual direction. It only talks about the volatility. And the part of that ADX that helps you to know if the market is volatile enough is this area called the level. Now, by default, there's not going to be any data, no figure in this level section. You need to add 25 to it. So when you add 25 to it, you click OK. What this means is that anytime the ADX is above 25, it means the market is volatile enough for us to take a trade. Like I said, the ADX is not going to tell you the direction. It's not going to tell you whether it's a buy or a sell. It's just telling you there's enough volatility for you to take a trade. So taking the trade now cannot be done. The direction cannot be based on other indicators, which we've mentioned earlier, whether those indicators are pointing you to buy or to sell. So when you want to take a trade, now the first thing you want to be sure of is your ADX above 25. Now for the ADX, our focus is this green line here. Now you can see the 25 mark by the side here. So whenever the ADX crosses above 25, it means the market is volatile enough to take a trade. And like I said, the direction cannot be based on what the other indicators you are using, what they're saying. So in this case now, we can see that the ADX actually crossed above 25 here, showing that the market is volatile enough to take a trade. So to take a trade now, I now need to confirm with the other two indicators, which is the moving average and the parabolic SAR, stop and reverse. The SAR stands for stop and reverse. And we can clearly see here that for the moving average, price is already above the 200 moving average. So that tells us that price is in the buy zone. And for the parabolic SAR, the dot already crossed from above to below price, and that indicates a bullish movement in price. And this simple combination of indicators is just a simple strategy that in this instance generated as much as about 80 pips just straight away like that. Now, these are 4 hour, so it's not it's not a day trade, it's a swing trade, and it was able to generate as much as about 80 pips. You can see it took some time, so it's not something that happened within a day. And we can flip backwards to check at other instances where we found alignment, because what we're going to be looking at is what is called alignment. Alignment talks about the time when multiple indicators are saying exactly the same thing, pointing us in the same direction, whether we're buying or whether we're selling. So let's go down to 1 hour time frame. Now, this is 1 hour time frame, and earlier on 1 hour, you can see here the parabolic SAR cross from below 25 to above 25. Price is clearly above the 200 moving average, and for the parabolic SAR, the dot already crossed, to the bullish direction, and this gave as much as about 18 pips. Let me look closely. It's about 20 pips in this instance. Now, this one is a day trade. It can happen within the same day. So the first one I showed you was, a swing trade that happened over a period, probably over a week, while this one is a day trade that happened within the same day. Let's look at another example right here. Here again, you have the ADX cross above from below 25 to above 25. Price is clearly above 200 moving average. Parabolic SAR crossed below price, and you can see an upward movement of price from that region. And we can clearly see here that price went as high as about 58 pips within the same day. And these are examples of bullish trades. So I want us to look at examples of bearish trade setup looking at the combination of these three indicators. So we'll flip backwards. Now, a word of caution here. Now, for the parabolic SAR, the 25 is for both whether the market is buying or selling. I did not say that you only use parabolic SAR above 25 for buy, below 25 for sell. No, I never said that. 25 is strictly just to tell us that the market is volatile enough. It's not telling us direction. Direction now will be based on other indicators. So even for a bearish trade, it is still going to be parabolic. So it's still going to be ADX above 25. An example is what I'm showing you now. You can see that the ADX crossed above 25 right here. Price crossed from above 200 moving average to below it. That's an indication to a sell. And the parabolic SAR also crossed above. And you can see from this candle here, price made its way down. And that gave as much as, let's check, that gave as much as 29 pips. And 29 pips is not bad for a day trade. It's still very, very good for a day trade. 30 pips on 0.1 lot is $30. That's $30 with the current exchange rate in Nigeria. I mean, that's well over 45,000 naira. That's a good trade. But please make sure you're using that 0.1 lot on the recommended account balance, which should just be like $1,000 on the minimum. If you have account less than $1,000, then you should be looking at smaller lot sizes. If your account is less than $300, you are not expected to exceed 0.01 lots. That is how you can be safe. The goal is not just about picking trades, it's about being able to preserve your account so that it can last long, in the market. So let's look at another example of a sell setup. All right, I found another one here. So we can clearly see we have the parabolic SAR crossing from, above, as in crossing above the price, indicating we're looking for an opportunity to sell. Price is clearly below the 200 moving average, and the ADX crossed above 25 here for a sell. And at least we can see some slight bearish movement. And this, let's check. This was able to generate as much as about 25 pips, which is not bad for an intraday trade. Intraday trading, at least you can generate between 15 to 25, 30 pips. It's still very much okay for an intraday trade. All right, it's a short one. Does anybody have any question? That's just basically what I want to show this afternoon. We've looked at three indicators. We've looked at the moving average. We've looked at the moving average. We've looked at the ADX, the average directional movement index. And also we've looked at the parabolic SAR. So if you have a question, you can go ahead and unmute, or you can type it in the comment section and I'll respond to you. It's like somebody was trying to ask a question just now, or was trying to talk. I saw someone unmuting. All right, so there's no question. We'll be rounding up. So what is most important here is that you try to practice these things that we teach. It's not enough to just attend these classes. Yeah, Mr. Cletus, do you want to say something?
Yes, sir. Good afternoon, sir.
Good afternoon.
Please, can you shed more light on the issue of moving average concerning the timing? At the 200 moving average, I sometimes see people using 14, I see people using 20. So can you throw more light on this?
All right,
Thank
for
you.
the moving average comes in periods, and the periods can determine, the time frame or how long we expect the trade to last. Now, the standard, like long-term trend for moving average is the 200 moving average. If you want something, if you want a moving average that is closer to a shorter time frame, then you can use a smaller moving average like 5 moving average, 10 moving average, 20, 50, 100. The choice is yours. I know some people use 14, 8, but for me, if I'm to add additional moving averages, I try to add double of the previous one. What I mean is this, I can do 5 and 10. Sometimes I may add a 20, a 50, a 100, then a 200. But then it's not really about the number of moving averages. It's being able to understand how it works. That is what is most important. Like now, if the 200 moving average is giving us a long-term view, because this 200, that's what it's doing, is telling you in the long term, this currency pair is going to be buying if price is above the 200 moving average. Now, there is also a flaw with moving averages. No indicator is 100% perfect. I said that when the moving average, when price cross above it is a buy, we're looking for opportunities to buy. When it crosses below it, we're looking for opportunities to sell. But there are some instances where this indicator may not be completely accurate. For example, here now, price crossed below the moving average. You might have taken a sell right here, but then it reversed into a buy. So that means that whatever trade you took on the sell at that instance could be a losing trade. And if you look again at this example here, at this point it crossed below. Well, there's a considerable movement here to at least take some trade, but the thing is, it eventually reversed. So there are times when it may not be consistent, and it's understandable. There's no indicator that is 100% perfect in forex trading. And that's why you cannot use one indicator to determine a decision to buy or sell. I see people do that thing and it's completely wrong. You can't say you're using a moving average alone to determine when to buy or sell, or you're using RSI alone or stochastics alone. No, you need to filter it with other indicators. You need to get your view from multiple sources so that you can take the best decision, where you think the market is going. So one of the ways to filter the moving average is by adding additional moving averages. So while the 200 moving average gives us a view of the long-term direction of the market, we can add smaller moving averages, as in moving average with smaller periods, to give us a view of what is happening in the now. So we now compare what is happening presently, matching it with our expectation for the future direction of price. So what I mean is this, I'll add the 5 moving average now. I'm more comfortable with 5 and 10, like I said earlier. So I'll add the 5 moving average. Now you can see that 5 moving average is a color red. It's closer to the price, it's closer to the candles compared to the 200 moving average. So that tells you it's looking at the short-term movement of price. Then I'll add the 10 moving average, which I can use a color. Let's use a color green for that. All right. So I have a 5 moving average color red, 10 color green. Now, you can see that the 5 is closer to price. The 10 is a little bit distance, but both of them generally, they are still way closer to the price compared to the 200 moving average. Now, what are we trying to achieve here? We said we look for a buy when price goes above the 200 moving average. We look for a sell when price goes below the 200 moving average. Now, here is a buy trend. But within the buy trend, you can see that we have some retracement here, which might mean at times we may lose some profit. So you want to look at the best time to enter a trade when the overall trend is bullish and when the current, trend, both the short term and the medium term and possibly the long term are saying exactly the same thing. And that's why we've added the two other moving averages. So what we'll use here is a principle called the principle of moving average crossover. So we say that the 5 moving average, which is the one colored red, we call it the fast moving average, and a green moving average, which is the 10 moving average rather, which is color green, we call it the slow moving average. So anytime the 5 moving average crosses above the 10 moving average, that means we're looking for an opportunity to buy. I'll take that again. Whenever the red, which is the 5 moving average, crosses above the 10 moving average, which is color green, we're looking for an opportunity to buy. And whenever the 5 moving average crosses below the 10 moving average, we're looking for an opportunity to sell. So if the overall trend is bullish based on the 200 moving average, you can now look for an opportunity to buy strictly when the 5 moving average crosses above the 10. Again, this will now be our valid entry point for a buy trade. And on the other hand, when the trend is bearish, when price is below the 200 moving average, then whenever the 5 moving average, which is red, crosses below the green, which is 10, that is when we look for an opportunity to sell. So that way, we have filtered our moving average effectively, looking at trend both on the short term and on the long term direction. I hope that answered your question, sir. Okay, I'm not getting the feedback, but that's the explanation on the question that person asked. Oladimiji Olarewaju, how can we add the pips? How can we add the pips to get the take profit? I believe you mean where do we set our take profit? Mr. Cletus, do you want to say something?
I said thank you very much. I think I like the explanation. I'm quite okay.
All
The
right,
five, the period of months, or that period represent which period? Like
it's
five.
just period short term. Just look at it as a short term trend.
Okay. Thank you
Yeah,
very much.
you're welcome. So Oladimeji is asking, where do we or how do we set our take profit? And that's a very brilliant question. Now, one of the ways to set your take profit, you can use the most recent high as your take profit. Like I'll add the parabolic SAR again and the ADX. So this is the ADX and this is the parabolic SAR. All right. So if you want to now use this new information to look at the trade setup I showed you earlier, we'll be looking to take a buy trade when the ADX is above 25, price is generally above the 200, then the 5 moving average crosses above the 10. That's our extra in our additional information. And the parabolic SAR, the dot is below, signifying we're looking for an opportunity to buy. So how do we now set our take profit? I said you can use I think we should go to a lower time frame for this so that I know most of us are day traders. All right. So this should be the valid region for this. Good. So ADX above 25, price above 200 moving average, 5 moving average crosses above 10, parabolic SAR is below. So we're looking for an opportunity to buy. Now, to answer the question of the person asking about the take profit level, the take profit level can be your previous high. In this case, this is the previous high. So if your entry is where I put the line there, then your take profit in this case will be that previous high, and that will be 26 pips away. So you can always use a previous high, or if there's a previous resistance, that can be your take profit level. So, because price will most likely hit that level, even though price may eventually go above it, but price must hit that level first before going higher. So that can be your take profit level. And for the stop loss, it's advisable that your stop loss will be below your most recent low, which is around the region where you have the parabolic SAR dots. Just some pips below that area should be your stop loss level. But the truth is that if everything works fine, price may likely not reverse backwards. most of the time. If everything is fine, it shouldn't reverse backwards. It's just good. Now, that doesn't mean that it's not possible to have a losing trade because it's possible a trade may be a losing trade, but here the probability for this trade setup is high, as much as 75 to 80%. So out of 10 trades, if there's going to be a loss at all, you may not lose more than one or two out of 10. So I've given you over 80%, winning potential when you use this strategy to trade. You're welcome, Mr. Ladimiji. All right, any other question as we round up? So if you're new to the platform, this is PU Prime. We're a global brand. It's a global head office based in Australia, and we have two offices in Nigeria, Abuja and Lagos. Now we run physical training at these two locations every Tuesday and Thursday. So if some of these things still looks a bit complex to you, you might need to attend our physical training session. So if you live around Abuja, Abuja and its environment, then you can be at our Abuja office tomorrow, Tuesday. We run physical training on Tuesdays and Thursdays, both in Abuja and Lagos. So you can find a way to Abuja office tomorrow or Lagos office for a physical training. So the address of our Abuja office is at 50 AB2 Okiwe Street, Jabi, Abuja. Work and Connect Building, 50 AB2 Okiwe Street, Jabi, Abuja. That's where we have our PU Prime office. And the PU Prime office in Abuja is actually the headquarters for our operations in Nigeria. So you can find yourself at our office tomorrow and get started with our beginners class, because on Tuesdays, what we hold is a beginners class, which is a foundational class for every trader. And if you're living in Lagos and its environment, you live at Iyanopaja, Mowe, Songo, Ikotun, all those axes, Ikeja, Surulere, find your way to our office in Lagos tomorrow by 10 a.m. For our beginners class. And on Thursdays, we'll run the intermediate and advanced training sessions. And again, don't forget, next week, Friday, is going to be NFP, non-farm payroll, which we're going to be having live. We're on live trading for NFP and CPI. So don't miss it next Friday. We're going to be trading live. We're going to be making money live. So if you're here this afternoon, you don't have an account with PU Prime, go ahead to our website right now and open a live trading account. Just visit www.puprime.com and open a live account. Once you open the account, your account manager will reach out to you and walk you through the verification process. And if you want to join us to trade next week, Friday, then you need to fund your account, because we're not going to be doing demo that day. We'll be trading live and making money real life. All right, so that'll be all for this afternoon. This class is being recorded and we'll drop the video, to your WhatsApp group so that you can watch it and get acquainted with what we've taught. All right, we'll see you again some other time. Take care and bye-bye.